Hey everyone, welcome to another video on my channel, and today in this video we are going to debunk RSI. Whenever you go and ask a beginner about RSI, he is going to say if the RSI has gone up quite a lot above 70 or 80, so we are in an overbought zone and the markets can end up coming down. Similarly, if we are below 30 or 20, we are in an oversold zone and the markets can actually bounce back. So today what we are going to do in this video is actually try to find out how RSI is calculated. So I'm also going to try calculating it on an Excel sheet and also teach you the fundamentals or the formula behind calculating RSI. With this, we'll be easily able to debunk the myths surrounding RSI. So today you will get to know what RSI can actually be used for and what it really indicates. I hope this video is going to be insightful, and before we move on, I have a small request for you. You can also support my channel by simply clicking the like button and also the subscribe button. In case if you are finding the content valuable, also make sure that you share the video with your friends. Apart from that, you can also open a free First Talk account using the link in the description, where you get 2000 rupees free brokerage, and you will also get access to our platforms like FinTarget and FinDiscretion absolutely for free. So make sure you check that out as well. And with this, let's quickly move on to the screen recording. So before we move on, I would like to show you some interesting things. So this is the chart from yesterday. Here we have the chart of Nifty and here is the RSI indicator. So yesterday you can see around 12:15 the market started to crash. While the market came down, the RSI also came down and we entered the oversold territory, right? So post that, you can see the market just ended up consolidating, but the RSI was actually back to the level of 50. Here the market hasn't reversed, rather it just consolidated for almost close to around an hour and we were back to the level of 50. So something similar can be seen even here. So you can see while the market went up, the RSI also shot up close to 70, but here you can see where exactly I'm pointing my cursor, the market has not even started to come down. We have just ended up consolidating for a while and we are back to the average of 50. So how exactly does this RSI work? So with this, you might have got a fair idea already. So before we even dig deep into the formula, so RSI is basically looking at the relative strength of the candles, or what is the average gain or average loss of the candles, right? So now we will dig deep and try to understand the calculations in detail. So this will start making much more sense. So you might have heard them say in basic RSI courses, if we enter any oversold zone, you can actually end up buying for a short gain. But here you can see if you actually ended up buying, so you would have actually made no money because the market consolidated and went down further. RSI came from the oversold zone to 50, right? So here what we are going to do is first try to understand how exactly RSI is calculated. I'll just put RSI formula. So you can see that RSI oscillates on a scale of 0 to 100. It's usually depicted graphically, and the formula to calculate RSI is 100 minus 100 divided by 1 plus average gain during up period by average loss during the down period. So the formula as such might look quite confusing, so you can see it right over here, but I will try to break this down for you and help you understand this in a better way. So what I have done right over here is basically taken the close of Nifty. So I am taking the daily time frame. So these are the Nifty closing rates. So what I will also do is copy this image and just paste it here. So we'll keep this as our reference side by side, and I will tell you what exactly we are going to do. And here all I have basically done is calculate the difference between the close. So between the close of 12th and 15th, so Nifty changed by 246 points. It went down by 246 points. And these are the daily change in Nifty. So this I have just ended up categorizing as positive change and negative change. So whenever we have seen the market going down, so that would be coming under the negative change. So whenever the market has gone up, that would be coming under the positive change. So you can see right over here, all the gain days are put in one side and all the loss making days are put in one side. So the next step in our process is to calculate the average. So average gain and average loss, right? So the thing here is, if you use the general average formula, right? it is just going to sum up all of this and it is going to divide by n. But that is not what we are looking for. So we are looking for the total average. So that means we are going to do the sum. So we have to do the entire sum divided by 14, right? So you can see the average gain is coming to 60. If you do a general average, so what it is going to do is it is just going to add up these numbers and divide by 6 or 7. So depending on how many values are there, you are going to get 120. So let me just explain why a simple average doesn't work and you have to divide it by 14. So just to give you a simple example, I will copy this and I am just going to paste it in a new sheet. So I'll give you the example why it is not going to be the same way. So assuming that, right, so you have negative 100. So assuming that you have negative 100 all the way till here, right? And let's say the last value comes down to be around 150. So now if we use a simple Excel average function, I will tell you what ends up happening, right? So here you can see we will actually end up getting an average of 150 itself, and here we will end up getting an average of 100. But if we actually end up using the formula where we sum up everything and divide by 14, so you can see this is divided by 14, which is 10, and when we sum up everything here and when we divide by 14, we are going to get a value of 92. So here you can see we are actually measuring the relative strength, right? So for the last 14 periods, the average loss has been much higher than the average gain, and that's the reason it becomes necessary for us to divide it by 14. So here you can see I have already computed the RS value and the RSI value. So let me just remove that and let's try to compute from the beginning. So RS value is basically the relative strength, that is nothing but the average gain by average loss, right? So here I have to convert this to an absolute number. I cannot divide it by negative 63, so I'm just going to add minus. So you can see here the RS value is 0.95. Next comes the RSI. So RSI is nothing but 100 minus 100 divided by 1 plus the RS value, right? So when we end up calculating this, we get a RSI value of 48, right? So here you can see it's quite easy to compute the RSI value. Now let's say we have one more data to add. So after adding the data, so we will leave the first data and we will consider the last data. So again we will leave the next data and consider the next data. So this way we will always be removing the top and adding one more at the bottom. So now what will end up happening is, assuming that I'll just delete this row, right? So we have anyway segregated. So assuming that there was a continuous dip of 100 points, the example what we used previously. So now let's end up using the same example of previous one, right? So we will remove all of this and we are going to enter 150. So now you can see the RSI value has actually dipped to 10, right? So here you can see average gain is 10, average loss is 92, the same example what we took here, right? So the RSI value has now dipped to 10. So here we have 14 candles, assuming the 15th candle, so I'll just come back here, right? 15th candle we get a value of 50, right? 16th candle we will lose 50, 17th candle again we will get plus 50, 18th candle we will lose negative 50, 19th candle we will get positive 50. So let's just continue this and see what will end up happening. So right over here you can see the following 14 candles. Let's assume the average gain and average loss is the same. So these were our first 14 candles and you can see the market has actually come down, right? So we have fallen quite a lot, and the next 14 candles we have just ended up consolidating, and now the RSI level is back to 50. So you could have also seen while I was changing the numbers how exactly the RSI would have also changed. So we have come back to 50 with no gains at all. So we have fallen quite a lot, we haven't gained anything, but you can see that RSI is now back to normal. So RSI is just going to indicate at that point in time what is the average gain or average loss of the previous 14 candles, and it has nothing to do with whether the market is overbought or oversold. So technically the market can continue to trend like how we saw here in spite of falling so much. So you have to trade based on the trend. So don't just rely on one of the indicators. So do trade based on the trend. So again, with respect to divergence, so you can see that here the market has actually gone up, right? So here the market has gone up till this period, whereas the RSI here has come down. So let me just zoom into RSI, has come down. So this is something what people call as RSI divergence, and they usually trade this as well. But now, since you know how RSI is calculated, you also know why divergence get created, right? So you can see during this point in time, right? So there were huge average gains. So let me just clear everything. So assuming that I am somewhere at this point, I'll be using the last 14 periods and the average gain is much higher. Next, what I'll do, I'll skip to this, drop one from here, skip to this, drop one from here, again skip to this, drop one from here, right? So you can see there were series of huge gains, right? So especially this was during the election, state election, where we gapped up quite a lot, right? So almost around 2% gap up was there, and we continued to rally. That's the reason we straight away went into an overbought zone. As we move forward, the previous 14 periods will not cover these candles anymore, right? So at one point, even this candle will be left out. Right, so even this candle will be left out. So maybe somewhere over here, if you go previous 14 periods, so you will straight away come to this, and this whole move will be left out. At this point, what will happen? The RSI will start coming down because the average gains are no longer so big, right? So that's the reason RSI will start coming down, whereas the market is still continuing to go higher and higher. The market rally hasn't stopped, right? So it is still continuing to go higher, just for the fact that we have left the big gain days right over here and we have moved forward. So this looks as though the RSI is falling, but the market is going up. So in my opinion, even the RSI divergence strategy is not a great strategy, to be honest, but you can always use it as a reference point, I would say, right? So RSI, let's say you want to enter a fresh position, just use it as a reference point. So the thing is, you can still argue, let's say we are here at the overbought position right over here, right? So we are already at an overbought position. In spite of that, the market has still rallied. So you can see from here to here, the market has rallied almost 7% in spite of being already at an overbought position, right? So that's why sometimes I say that, okay, indicators are something which we shouldn't rely heavily on. So RSI is telling we have already seen a huge rally of say 8%. So market is already in an overbought zone after a 8% rally. So RSI is showing a divergence, but in spite of this divergence, you are having a further rally, assuming that you had missed here. So you would have missed further 8% rally in spite of an RSI divergence, RSI being in an overbought zone. So that's why it's very important to understand the fundamentals of any indicator you're using. Don't blindly follow any indicator, right? So that's why I often say I am not a big fan of using any kind of indicators, because end of the day, all of this is dependent on the historical data, and all RSI is doing is simply comparing the average gain and the average loss, and it has nothing to do with the direction of the market. So it simply assumes that just because the market has gone up, the market should either consolidate or come down. That might not be the case always. So you can see that in spite of market going up, we can further go up, and we can consolidate and further go up, and there is no issue with that at all, right? So this is something which I wanted to debunk the mystery around RSI. Many people are selling the course on RSI without really understanding what exactly RSI is and how it can be used, right? So that's why I just wanted to bring into light on how exactly this indicator works, and I also hope with this video you found some insight, and this video was actually useful for you to get a clarity about the indicator. In case if you have found it informative, you can please support me by hitting the like button. You can also open a free First Stock account using the link in the description below and get 2000 rupees worth of brokerage credit to your account. Make sure you check that out, and with this we also come to the end of this video. So if you have liked this video, share this video and also subscribe to the channel. Thank you so much.